Hello, everyone. My name's David Moore. We're going to get started right now on time. Thank you for joining us. I see we've got a fraction of the people signed up here. Must be like me. I'm having a hard time getting going today. I think maybe it's all the talk of the tax proposals and everything tonight. I'm really curious what we hear from President Biden. And I think it sort of obviously dovetails into what we're talking about today, because if some of the proposals that the Biden administration has put forth, imagine capital gains tax rates practically doubling up to a max of 48%. And I want to remind you that's the federal, and you're going to have state on top of that. And potentially, unless they do something with the healthcare tax, you've got another 3.8. So you guys can do the math. The states where there's no state tax, it's going to, we've got just a FYI on our 1031 business. I'm David Moore, IRA Advantage. Today's presentation is on retirement accounts and tangible assets, how to use your retirement funds to buy real estate. And we've got a sister company, Equity Advantage, that's 30 years old, one of the oldest exchange companies in the business. And I'm watching very carefully from that side of the office, because those tax rates, if I look at our volume, our business right now, this last year has been the busiest year we've ever had. Last month, honestly, was the busiest month we've ever had in the 1031 space. And I think it's, if I look at our numbers and I look at what people are doing, people are definitely moving from blue to red states, not just with their investments, but with their bodies as well. And I think that if things go through and you look at those tax rates, I think that we're going to see more and more pressure to use real estate as an investment option for your retirement account. And that's obviously why you are here today. And if you're a real estate broker, understand we're going to be talking about the basic do's and don'ts. I'll give you some practice tips on that, how to make sure you're writing things up, how to keep your people out of trouble, and actually how to have a positive situation with respect to buying and selling the property for your clients. If you're an investor, then we're going to give you 3 different ways to buy real estate with your retirement account. It'll be basic self-directed IRAs, checkbook IRAs, and if you're self-employed without employees, we would look at a solo 401k for you. But we all see the ads on TV. We all hear the ads on the radio, probably see them for those of you that read papers, but you're seeing it online. Talk about tangible assets. We get those gold ads daily. And what are they selling? It's a tangible asset, inflationary hedge. Inflation's going to happen. Period. It's here. It's just going to get worse. Try to buy a gallon ice cream anymore. You can't. It's a quart. You know, if you're looking at a pound of coffee, it's no longer a pound of coffee. You're getting something less, but you're paying the same thing. So, you know, lots of people say, well, we haven't had that much inflation. We have. Just look at what gas prices have done over the last, well, since January. But we look at real estate, I would say it's the ultimate tangible asset. My background before starting Equity Advantage with my brother, and then later IRA Advantage, also with my brother, we always looked at those things. I was always a real estate guy, and I still am a real estate guy. And I look at it, and I was taught never to bank on appreciation. Real estate, you don't have to. If you buy gold, silver, any of those things, you're betting that it's going to go up. Now, they're great inflationary hedges, but you're still betting that things got to go up. Real estate, I was taught not to bank on appreciation. I was a value add guy. I'm going to look at something, answer 3 questions. What am I going to make? How am I going to make that money? When am I going to make it? If I can't answer the questions, don't do it. And the problem with what I did is that in the region, I'm talking to you today from Portland, Oregon. Bulk of our business is outside of Oregon these days. But if I look at our Oregon clients and why I came here, value add opportunities have been virtually destroyed via the rent control issues that we have to deal with. And our politicians continue to make things tougher. And what I mean by that is we had a number of clients, some of them might be on this presentation, that had taken their retirement accounts and bought Vrbo type properties, vacation rental by owner, and it worked a great investment for them with those retirement accounts. Well, our politicians have decided that you cannot use VRBO unless it's an owner-occupied property, which would constitute a prohibited transaction in the retirement space. So obviously that's no longer possible, and consequently there's less property available for people to use. So understand that we're sort of in a game here. We're going to work with what we can. One of the other things that's being proposed in addition to the capital gains, well, I shouldn't say being proposed, I'm waiting on bated breath to see whether or not they're going to talk about anything with respect to 1031. But if you've got questions on 1031 its future, at least from what we knew, we've got a webinar that we presented in January. Inland Private Capital's governmental affairs officer presented it. And he talks about what the sort of general attitude was. At that time in January, we were looking at a situation where it appeared that all those tax proposals that Biden had come forth with were pre-COVID, and obviously that changed the game dramatically. And if we look back in January, the idea at that time was, well, they're busy enough, they've got to deal with COVID, and then they're going to be dealing with some other issues, the immigration issue and all, and it would be probably the second year of his term before he got to taxes. Well, that didn't happen. And the idea was they wouldn't do anything with taxes ultimately if it's the second year, because you've got midterm elections. They didn't want to give up control of the House or Senate. And now, all bets are off because everything's happening very, very quickly. So we'll see what happens. I haven't heard much about, I haven't heard anything with respect to 1031 lately, but hopefully it'll stay intact. It's a 100-year-old tax code, and it obviously works very well. And think of the cost of a single transaction if you take that transaction away from taxation. You've got one sale, you've got obviously brokers, the property owner, title escrow people, finance people, inspectors, appraisers, Home Depot even, contractors, all those different people that are paying normal income tax based upon that transaction occurring. Now, if you get rid of 1031 and you increase that tax, that capital gains tax rate to what they're talking about, what's it going to do to the real estate market? What's it going to do to people's income, so on and so forth? So we won't burn any more time on that topic until we know what's going to be said tonight, but I just wanted to mention it and really keep your ear to the ground and pay attention to what's going on, because it's something that really today's topic is ideal. Today, we're talking about something that would not necessarily be impacted by it, because we're talking about capital gains tax rates being bumped dramatically. We're talking about other things that are going to stagnate that market. Your retirement accounts, whatever money is in that account, if we're talking traditional IRA money, it's pre-tax money growing tax deferred. If we're talking Roth funds, it's simply tax money growing tax free. So if you look at that, and the taxation in this space is not on a capital gains tax level, it's normal income tax. So it's a different thing. And it potentially it's something that is going to be the way of the future if they take these things away. So ultimately, understand real estate is the ultimate tangible asset. And as I said, you're not betting on it appreciating. Ultimately, over time, it's going to, but you've got all those other benefits. Unlike if you pull money out of your pocket, you've got a larger bundle of benefits than you do with a retirement account. And what I mean by that is, if you personally own real estate, what happens? You're taking your money, it's tax money that's buying it. And in at least today's world, we're typically going to be looking at the tax consequence of a long-term gain most of the time. If you're flipping property, it's normal income tax, but typically you're looking at long-term. And that's if you choose to pay the tax, or you do an exchange, just kick the ball down the road over and over again. On top of that, if you've got leveraged investments, you're going to have interest deductions, depreciation if it's got improvements on it. And you've got all these other things, that cash flow coming in. Somebody else is buying the asset for you. I actually heard somebody a couple of weeks ago, it was on the news, this person thought that they should be actually one of the owners of the property since they're paying the rent, which is paying the mortgage, which is pretty comical. But hey, I wouldn't put anything past the current administration, so who knows what's happening there. But understand that when we're looking at the retirement account, you're not looking typically at interest deductions, depreciation. You're not looking at a gain situation. You're just talking about increases or decreases in the value of your retirement account, which is going to be taxed when you pull that money out. So just look at it that way. Understand that's where we're going with it. And today we're going to talk about using your retirement account, whether you're an investor or you're a broker, and how that's going to happen. And we're going to talk about creation of the account. We're going to talk about what is out there, how you're going to make it work. If you want leveraged investments, how that's going to work, what type of loans are required, how to write an offer, how to cover the carrying cost during the time you own it. Then we've got a series of slides, examples at the end. I'm going to apologize. This is the first presentation, first time I've presented this presentation, and I just have a really hard time pulling information out. I feel like every page has got something that's critical. There's 30 pages plus a few pages just with definitions at the end. But 30 pages information, which means two minutes a page. I'm already talking 10 minutes and I haven't gotten into it yet. So we're going to be scrambling through some things. I'm going to put it out there. There's a sidebar on the side, some housekeeping that has a section for questions. If you've got a question, I'm not going to cover it today. Write it down, get it to us, and we will respond when we're getting information back to you after the presentation. We'll address those questions. And also, if you have to cut off this webinar early, this will be recorded. It is being recorded, and it will be up for you to be able to see and or reference at a future date, whether it's for you personally or for clients. So don't hesitate to reach out with any questions you've got. The only dumb question is the one that's not asked. So without further ado, here we go. So tangible assets, inflationary hedges. I mean, what do you look at? Typically, we're looking at precious metals, things like that. And they're great, they work well. But as I said, real estate, in my opinion, humble opinion, is the ultimate tangible asset. Now, what's funny about whether we're talking about precious metals or real estate, for example, we're talking about in the investment world, these are looked at as alternative investments, which is so one of my little beefs. For the people that out there that deal primarily with real estate, understand, I mean, name an older investment than real estate or gold or silver. I mean, there's nothing older. So how come those things are called alternative investments? And I mean, if you look back at what got us into the mess back in 07, 08, synthetic derivatives, that's a legit investment, and these things are not. So understand when you're buying these things, they're going to go. If you've got a debt-free piece of property, it can't go away unless you fail to pay the property taxes on it, and you fail to do that for a number of years. So really, if you're looking at debt-free real estate, it's a very stable asset. The value may go up and down over time, but if it's an income property, you've got that cash flow that's going to be taking care of you, whether it goes up and down over time. And you're going to be looking at these things over your investment life. So if we're looking at a property that you've bought with money out of your pocket, when you buy that thing, you're going to have, as I said earlier, you're going to have that purchase, you're going to have the cash flow on the property, you're going to have interest deductions, depreciation. End of the day, you're going to have long-term capital gains tax, or if you don't want to pay any tax, you're going to do a 1031 exchange and defer that, at least while we've got 1031s. If we put the retirement account into that real estate, you're not going to have interest deductions, depreciation, all that stuff. And the first thing I want to say is look at your retirement account as not you. I mean, I always say, hey, it's Susie down the streets. It's not yours. And the reason I say that is when we have problems with these transactions, rarely is it the investment that causes a problem. What causes problems for people is transactions between or for the benefit of disqualified parties, somebody doing something they're not supposed to do. A prohibited transaction, we'll talk about a little bit more in a few minutes, but a prohibited transaction with a retirement account is something that would distribute all funds in the account as of the first day in the year in which the indiscretion occurred. You do not want to commit a prohibited transaction with your retirement account. This is something that's very important. IRAs, that's a catastrophic problem with them. 401k plans, a lot different. 401k plans, you commit a prohibited transaction. Only the money involved with that indiscretion is treated as a distribution. So I'm going to say, when we're looking at the real estate, when we're looking at people coming into us, if somebody comes to me and they want to put an account together, it's because they want to buy something that Wall Street doesn't sell, whether it's real estate, notes, loans, precious metals, We can do all kinds of things with these accounts. We're starting to see, now that we're a year into this COVID situation, if we go back 07, 08, 09, we did a lot of what's called a rollover business startup. And what that is, it's a combination of 401k plan and a C corporation, and we can literally create a new business that's owned by your retirement account. So we did a lot of those in that last crash, and we're starting to see them come up. Now we had somebody yesterday that called up, said, hey, I was laid off a year ago. It's pretty obvious I'm not going to get my job back. So now we're putting a new business together for them. So there's all kinds of options out there. As I said, the only dumb questions one you don't ask. Understand what's possible and understand you've got a source for answers. So if you got questions, we've got the answers. Call up, ask the questions, discuss what you want to do. Don't hide behind the keyboard. Call us up. We can get through what you want to do in a few minutes and really give you some direction, where we're going to go back and forth forever if you're emailing back and forth, just sort of bit piecing information to us. So it's really wide open with respect to what you can do. The other thing I'd like to say is that I might have done transactions for somebody in the 1031 space for 20 years. I never see them, which is sort of interesting to me. I will then put a retirement account together for that same person, and they come in, and I ask them, well, why are you coming in today? I mean, we've dealt with you, we've known you for years, and I've never seen you, and now you're in. Well, this is my retirement account. So in general, I see people more conservative with their retirement account investments than I do with money out of their pocket. And that's just the way it is. I'm not trying to say, there's any reason that's good or bad, but it's just something that I've observed. 1031s, they just sort of, hey, do it for me. And the retirement account, they really want to understand what's going on with it. Self-directed IRA is not a legally defined term. It's just a term that describes an account that allows you to go buy what you want to buy. So if we look at a self-directed IRA in the most basic sense, all we're doing is moving money. You're not pulling money out of your account. We're just moving the money from a custodian that won't allow you to do what you want to do to one that will. If we're talking about a 401k plan, we're just changing the plan that restricts your investments to, let's say, Wall Street's offerings, and replacing or amending that plan with a plan that will allow you to buy anything the law allows. So when we're talking about truly self-directed accounts, they are not something in the Wall Street sense, okay? A Wall Street sense, self-directed account is going to allow you to trade what you want, in the timelines you want to. Where we're talking about truly self-directed accounts, something that's going to allow you to buy literally anything the law allows. Now, the downside is you've got to be careful. Wall Street, you got a safety net. You might make a bad investment. In a self-directed space, it's often the case where you don't have a safety net. So if we're doing a checkbook IRA, for example, when we name that limited liability company, quite often people want to name it, if you're John Smith, they want to name it Smith Investments LLC. And I'm going to say, do not do that, because I want to make sure that anytime you look at that check account, it's painfully clear that it is not you. So back to Susie down the street, whatever you buy with this retirement account, it's not yours. You're managing those investments, but it's not yours. Therefore, any yield off those investments is not yours either until you take it as a distribution. As long as you're keeping things clear that way, you're going to be fine. So we want to make sure that things are looked at every time you pull out a checkbook IRA. Hey, this is not me, this is somebody else. And if there's a taxation issue for that retirement account, it's not your tax obligation, it's the retirement account's tax obligation. And I'd like to say, we are not taking money out of your retirement account to make these investments. We're simply shifting, and it's not all or nothing. We're going to shift what you want to use in the self-directed capacity into the new self-directed account. And I'm going to tell you, with an IRA, keep your Wall Street stuff with your financial advisor, the one you're working with. Keep it there. We will open that new self-directed custodial account, which is then separate. And the reason I say that is that if you commit a prohibited transaction in that self-directed account, you've got all the money in the account, you've just blown up the whole thing, and it's all been distributed to you, and you taxed on the whole thing. If we keep the Wall Street stuff where it is, now it's segregated. The Wall Street stuff is isolated from the self-directed, and you don't have that same issue. So we're not pulling money out of a retirement account. We're just adding an account or changing the custodian of the account. If it's an IRA, 401k plan, once again, we're simply amending or replacing the plan with something that's going to allow you to do what you want to do. And one other comment on it too. These self-directed accounts are not new. I mean, retirement accounts were started in the mid-70s, and it's always been possible to self-direct. It's just a very tightly kept secret, I guess. So we're not doing anything that's new. It's always been possible to self-direct and make the investments we're going to be talking about today. So when I look at a retirement account, I like simple, okay? A good buddy that used to work for me used to love that KISS principle, right? Keep it simple, stupid. So when we look at retirement accounts, I'm going to tell you, look at two issues. What do you want to buy? And who are you transacting between or for the benefit of? And an IRA literally can buy anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. A 401k plan can buy anything other than collectibles. So rarely is the investment going to be an issue. What causes the problem is transactions between or for the benefit of a disqualified party. So what we don't want to see happen, you don't want to transact or buy from, sell to, loan to, borrow from a disqualified party. You can't buy, let's say, a property at the beach and use that property, nor could your kids or grandkids or parents or grandparents. You can't do those things. You hear me talk about buying a retirement home. You say, well, David, you talk about buying a retirement home and you just told me we can't use it anyway. So, well, okay, so what we're going to do, we're going to buy the asset, and instead of taking in-kind distributions, or in-kind cash distributions, you're going to take an in-kind distribution. And what I mean by that is we might own the property at the beach in a limited liability company that has as its member the trust company for benefit of your IRA when we buy it. Now, over time, that entity is going to change the membership. And instead of taking cash, you're going to start assigning a membership interest in the LLC as a distribution. So you don't want to do this until you're 59 and a half. If you're under 59 and a half, you're going to have a penalty for doing it. After 59 and a half, you're just paying normal income tax on those distributions. And we'll talk about discounting a little bit in a while too. But that's how we buy that retirement house. We're going to buy it. We're going to simply assign interest in it over a series of distributions, and it might be a membership interest in a limited liability company, or it could be a deeded interest in the property, but slowly you end up owning the asset. And the only problem with an in-kind distribution really is that you're going to have a tax obligation without receiving the money to pay that tax obligation. So you really have to look at it and understand what that tax obligation is going to be and be prepared to pay it. Now, I believe he's on this call, one of my oldest friends, this guy named Robert Nelson, and he's a wonderful individual. And I don't know how long, it was probably a dozen years ago now, we were talking about, he's got apartment buildings in his IRA, and he was talking about converting it from a traditional IRA to a Roth IRA, which, once again, traditional is pre-tax money growing tax deferred. Roth is tax money growing tax free. And he was just looking to do this because he had the idea, hey, he wanted to take care of his wife if he passed away and didn't want her to have any tax issues. So he was looking to do that Roth conversion. Well, just like an in-kind distribution, Roth conversion is going to trigger taxes. You've got to be prepared to pay the tax obligation. So Bob came up with the idea, hey, David, can I just pay the tax obligation with a cash out refi after I've taken the property out? And that's, that works beautifully. So whether we're talking about a Roth conversion or taking in-kind distributions, pulling a property out of that retirement account, the cash out refinance after you've received the property is going to take care of, or potentially take care of, any tax obligation there. And I think that's just a great solution. Bob, it was a great idea, a dozen, 15 years ago, whatever it was, and it's a great idea today, great solution. So understand whatever's in has to come out. I talked to somebody in the 70s the other day, and just remember that it was at 70 and a half. Now it's at 72. You have to take money out. You have to take distributions required. So the RMD age, required minimum distribution, is now 72. So I was talking about when we buy something, what's one of the knocks on real estate? Well, it's not liquid. What happens? You've got to take a distribution. You don't have the money to do it. How do you do it? And once again, we're going to take those in-kind distributions, and the way we pay for that is as soon as that last distribution's happened, then you can go out and get a cash out refinance through a traditional lender. Great, great idea. So why self-directed account? Well, the roller coaster, right? It's the top picture. I love roller coasters. I don't like roller coasters in my investments. And my wife gives me a hard time all the time because the stock market drives me crazy. I mean, I can't look at it. Real estate, I'm sort of calm and collect. I know it's a long-term deal. And you know, honestly, your Wall Street stuff probably should be that too. But you're tired of the stock market's roller coasters. You got greater financial control too with this stuff. So I'm never a proponent of taking all your money and putting it in any specific asset. I'm going to tell you, diversify. That's the secret to success and stability. You know, one of my brother-in-laws is, you know, he always talks about the tripod. He likes three things. Tripod's always stable. It never rocks. And you know, hey, there's something to be said for that. But tired of the stock market's roller coaster, greater financial control, invest what you know. Think about that. If you've got specific knowledge of something happening in Wall Street, can you legally use that knowledge? Now, if you're a politician, maybe, for some reason. I don't know why that's the case. But anyway, if you look at what's there, I always give the example of Martha Stewart. I'm not her biggest fan, but she's certainly not the biggest culprit of insider trading. And here they try to make an example of her. So if you're a mortgage broker and you want to go out and use your retirement account and make loans, do it. If you're a real estate broker, hopefully you've got better knowledge of the real estate market. Use your retirement account to take care of that stuff. In the self-directed world, you can use your knowledge, you can do what you need to do, take advantage of your strengths, you know, reduce that risk. Invest in what you know. Real investments, not alternative investments. We've talked about that. Community-based investing. A lot of times people want to make a difference in their community. You can do that. So you're not just putting money, sending it off to, you know, New York and it's going into wherever it's going. If you want to make an investment locally and improve the community, you can do that. So community-based investing is definitely there. Increased investment flexibility, opportunities. Now, a basic self-directed IRA is a little bit cumbersome. We're going to talk about them in a while to make things happen. A checkbook IRA is simply writing a check. I mean, it is what it is. It's as easy as you going to buy something. A solo 401k plan is going to work the same way as a checkbook IRA. You just write a check to go buy what you want to buy. So it's very easy to do what you want in the time frames that you want to make it happen. A basic self-directed IRA involves you submitting an investment to the custodian upon their approval to make the investment. So it takes some time. If you're a real estate broker, you're not going to want to work with somebody that's got a basic self-directed IRA. It's just too cumbersome and complicated to make things happen. That last bullet down. Okay, so security. What do I mean by security in this? Well, what I mean by security is the money's not someplace else. If you've got a checkbook IRA, you've got a bank account in the bank of your choice in your checkbook IRA LLC's name and tax ID number. So if you want a regional bank, you want to have the bank around the corner have your not custodial account, but your LLC's account, it's there. So you're putting it where you want to put it, not with some trust company or custodian that's halfway around the world. That's that security. People are comfortable with that. They know what's going on. If you want to take physical custody of gold, for example, you can do that with a checkbook IRA. So that's something that people do. But that's that security component. The bottom bullet there, maybe it's the course of your future. Rollover business startup's going to allow you to, that's the olive branch to where you want to be. So understand there's a lot we can do. As I said, the only things you can't buy with an IRA are collectibles, life insurance contracts, and stock in a sub-S corporation. So rarely is that investment going to be an issue. It's pretty much wide open with respect to what you want to, what you can invest in. Well, I should have looked at this page. It was a late night. Anyway, so this page talks about it, and I'm going to zip through a few of these pages. As I said, you're going to have access to the slides on this thing, the deck later. So use it as it helps you. I mean, use it for whatever you need to do. We're always happy to help with what's going on. The investments just need to be for investment, period. purposes, period. And if we're looking at, so think back what I said, retirement accounts, I got two issues. What do I want to buy? Who am I transacting between or for the benefit of? If I'm looking at 1031 exchange, I've got four factors I look at. You know, it's got to be an exchange. What's going to receive have to be of like kind. For total deferral, you need to go across or up in value and equity. And finally, we've got to have continuity vesting. But when we look at the like kind requirement with 1031, any real property held for investments, like kind with any real property acquired with the intent to hold for investment. Now, one comment on hold periods in 1031 right now, I just want to put it out there because it's fresh in my mind. When we're looking at a retirement account, we're not really looking, we're not looking at long-term capital gains or normal income tax. We're just looking at normal income tax on distributions. 1031, we're in a situation where hopefully we're deferring all of your tax. But if you look at the break between short and long-term tax rates on assets held for investments at 1 year, does that mean you've got to hold a property for a year to have it qualify for 1031? Further, I have lots of people call up with the idea they've got to hold a property for 2 years. There's no stated required hold in Section 1031. I'm going to say it again. There's no stated required hold periods in Section 1031 other than a related party transaction. So if I'm your brother and we swap properties, then we've got a 2-year required hold. But if you read the fine print in the code, even in that situation, it says unless there was no intent to avoid tax, which leads me to another thing. Rarely in the tax world is there a black and white answer. There's a lot of what ifs or how we're going to do things, but rarely is it black and white. But you're looking at that 1 year hard time for the break between short and long-term tax rates on assets held for investment. You know, if we're conducting business with a retirement account, you're going to be subject to unrelated business taxable income, UBTI. An example might be you go out and buy an apartment building, and the apartment building has a laundromat in it. Well, you've got an investment there. The laundromat's a component of it. Now you like the laundromat, you go out and buy a laundromat. That's a business. You're going to have some tax exposure on what's happening there. And you say, well, gee, why am I going to have tax exposure? I've got a Roth IRA. I paid the tax. It's all supposed to be tax-free. Well, now you're conducting business. Government doesn't want you competing unfairly with the tax world in that situation. So in the IRA 401k space, if we've got people conducting business, there's going to be some tax exposure. If you're making leveraged investments with an IRA, you're going to have some tax exposure. We'll talk about that in a bit. Disqualified parties. So as I said, the last page talked about what we could buy or not buy. And this page talks about disqualified parties. So what I said at the beginning is, rarely the investment problem is transactions between or for the benefit of a disqualified party that cause a problem. Who's a disqualified party? Your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those people. All right. Now, what's interesting is you cannot transact between or for the benefit of a disqualified party. But I want to stress this: you can transact along with a disqualified party. So what does that mean? That means that, let's say a piece of property is $500,000 and you've got $250,000 in your retirement account, and you want to be a joint owner of that property along with your retirement account. That is fine. You can do that. And you can do it either via tenancy in common, so undivided interest, joint ownership, or you're going to do it as common members of a limited liability company. Each of those has its ups and downs. I honestly like the tick structure better because at the end of the day, 5 to 7 years later, you're probably going to turn the asset. You personally are going to probably want to do an exchange unless you're just going to pay the tax. The retirement account gets that tax deferral unless there's some leverage there. So that tick structure allows each entity to do what they need to do going forward to keep its money or your money yours. If we use the limited liability company with you and your retirement account as members, which is fine, we've got to overfund the initial funding of that LLC, because the initial investment in the LLC between two disqualified parties is fine, but we cannot add additional money in the future because additional funds coming into that LLC in the future, I'm not talking about the yield off the investments, I'm talking about contributions or additional investments into the LLC. Those things would be a prohibited transaction, because that entity, after it's funded, now has two members that are both disqualified parties to one another, and you've got a disqualified party that's wanting to put money in. So if you want to have an LLC owning an asset, I'm going to tell you, if it's a $500,000 purchase, you probably need to put another 10–15% in there just as reserves. If you're looking to buy a property with leverage, it's got to be a non-recourse loan, and those loans, the lenders typically want to see a 15% reserve, because if there's a problem with the property, you can't just pull money out of your pocket to take care of it. The retirement account has to do it, so they want to have enough money in there to cover any potential issues that are there. So what kind of real estate qualifies? Rental houses, apartment buildings, office buildings, retail centers, land, any real property to be held for investment of future retirement home. We talked about that. What can't you do? You can't buy number one, a primary residence, but I have that question all the time. Second homes, home for disqualified party. How about an office building? I get lots of clients that want to go out, and I mean, it makes great sense, and it should be legal in my humble opinion. Why not? I mean, if retirement accounts are there to give you a secure future, why not give you the best opportunity to get to that secure future and have the office building owned by the retirement account? But the reason you can't buy a building and put your business in it is that's ultimately a transaction between disqualified parties. Your business is the tenant of the building that was owned by the retirement account, therefore it's a prohibited transaction. So I want to stress once again, you cannot buy a building that your business is going to occupy using your retirement account. Now, if we do a rollover business startup and that building's another asset of the business, that's fine. But if we're just talking about making an investment with a retirement account, you cannot go buy the building that you want to run your business in. That would constitute a prohibited transaction. Common objections. So we look at this stuff, and when I look at retirement accounts, we start going through things, and I just, a lot of the objections that I get. Number one, I think there's firms that put out a list of objections that if they have an investor come to them and say, hey, I want to self-direct something, hey, these are the reasons to say no to this situation. And these are ridiculous. They're pointless statements. And I've actually had to address these statements, I don't know how many times through the years. But the first one is, yeah, sure, if you buy a property with your retirement account, you're going to lose long-term capital gains tax rates. Now, if you ask me, hey, am I better off pulling money out of my pocket to buy the property, use my retirement account? I'm going to tell you, use the money out of your pocket if it was only one of those things. But that's not the case. What we're talking about is money that's in your retirement account. What's the highest, best use for that money? The loss of long-term capital gains tax on an IRA-owned piece of property, let's say, that's a pointless issue. There's nothing you're going to buy with your retirement account that gives you long-term capital gains tax rates. So forget that one. It's off the table. Anybody that says, well, you shouldn't do it because of this, it's a pointless statement. Second, you cannot leverage an IRA or 401k owned asset. Totally incorrect. You can do it all day long. It's tougher, it's more expensive, but because it's got to be non-recourse debt, but you can leverage an IRA or 401k owned asset. What about RMDs? Now, this is another one, and I broached a few minutes ago. You get a point where now you're 72 years old, you have to take a required minimum distribution, you don't have any money in the account, and now you're going to be penalized because you didn't take the distribution. Well, the easy solution to that is to take a piece of an asset or an assignment of membership interest if you've got a checkbook IRA of that IRA LLC. That takes care of your RMD. And honestly, it's not only not a problem, it's potentially a great opportunity, because in the financial planning world, gifting is always an issue. You've got state limits, and then you've got annual giving limits that you can do. And the annual limit is 15 per person per year right now. So, and for future viewers, this is 2021. So 15K per person per year. If you gift an interest in something, a minority interest in something, it's common in the financial planning world to discount that valuation. Your tax people are going to discount the value of that piece because that person that received that minority interest doesn't have enough to control the asset. So it's common for those gifts to be discounted up to 40%. Well, guess what? That discounting can also be applied to in-kind distributions. So not only is that situation where somebody might say, gee, you shouldn't buy real estate because it's not liquid and you don't have the money to get the RMD, that's not only not a problem, it's potentially a tremendous opportunity. Now, as I said earlier, in-kind distributions, the problem with them is you're triggering tax without having the funds, without receiving the funds to pay the obligation. So how you get around that, if you take the last minority distribution, you immediately engage your finance people, do a cash out refinance, that money is going to take care of that tax on that in-kind distribution. So that's the way I see it. And it's, like I said earlier, no different than Mr. Nelson's situation with the Roth conversion and the cash out refi after that thing had occurred. Lose interest deductions, depreciation. Sure, that's true, totally true. Name something in a retirement account that gives you those. So once again, it's a pointless statement, it's a pointless objection, it means nothing. I've had discussions over and over and over again with people in the tax community on these things. And you just got to look at it and rationalize what's there. Don't just, my father used to say, it's amazing when you see something on TV or you read something in the newspaper, if you know something about it, it's so often amazing to know how wrong it is. So think about that stuff. Don't take what you see at face value. Understand, ask the questions, look at what's there, and rationalize what's going on. These are objections I get all the time, and none of them mean anything. They're pointless. So how do we do these things? These are just this slide just talks about, any IRA can be self-directed. When we're talking about other plans, we can typically move funds out of plans too into these self-directed accounts. So once again, I'm going to say it, any IRA can be self-directed. When we're looking at 401k plans, 450s and 403bs, whatever those things, any of those, it might be an age appropriate situation. For example, if you're happily employed and it's a current employer plan, you can't touch the money till you're 59 and a half. I've had people step away from their jobs to get access to that money. Even owners of businesses step away from their jobs to get access to those money. So understand that corporate sponsored plan, happily employed, current plan, we're probably stuck unless you're 59 and a half. Any IRA we can work with. If we're talking about moving IRA money into a 401k plan, then we can typically move most most IRAs in, but we cannot work with Roth or beneficiary IRA. Beneficiary IRA is one that's been inherited. So how do we do this? All right, it's simple. Okay, if you're doing a basic self-directed IRA, you don't need us. We'll happily take care of it. I think we charge like $450 to a self-directed IRA, just a basic self-directed IRA. We're going to talk about the cost for a checkbook IRA 401k plan in a few minutes, which, about $2,300 initial setup. But a basic self-directed IRA is going to be, you can put one together for under a couple $100 bucks. You can go to any number of trust companies like Forge Trust, Equity Trust, SunWest Trust. There's a whole bunch of them out there. Not a whole bunch, but there's probably 20 of them that are the bigger ones that have been doing it for a long time. And they've got online applications. You can fill the stuff out and do it. And it's going to cost you under a couple $100 bucks to take care of it, and it's very easy to do. The toughest thing about establishing a basic account is moving the money from your current custodian to the new custodian, because a lot of times the current one's not that excited to lose that money. But it's as simple, if you're working with us and you want to engage us to do a checkbook IRA or do a basic account, really, it's as easy as filling out a 2-page application. And most of that information is just your basic information. It's going to talk some about the accounts, and it's going to ask about who your beneficiaries are, what you want to invest in. If it's checkbook IRA, we're going to want to know some potential names for the limited liability company, state of registration for the limited liability company. And we're going to need that stuff returned to us along with a copy of a photo ID and your current account's most recent statement. If it's a 401k plan, you're going to have to talk to your account administrator or trustee and get the distribution rollover form from them. And you're basically going to fill that information out, direct them to forward funds to the new custodial account. If we're talking IRA to IRA, most of these self-directed companies are going to actually have a form. It's a transfer authorization form, which is a form that's going to allow them to go to your current custodian and ask them for the money. So it's direct custodian to custodian transfer. I want to stress once again, any of these accounts, we're not pulling money out of your retirement account. We're just changing all or a piece of it from one custodian to another, or from your 401k plan into an IRA, or maybe from an IRA into a 401k plan if it's a solo situation. But you're not pulling money out. It's just going from one type of account to another. And so you're not dealing with those issues. Now, we are doing many reverse exchanges these days in the 1031 space. You know, why? Well, I had broker last week, I think, they put a property in the market, got 70 offers in the first day. Reverse exchanges allow you to buy first and sell later. So it allows people to make things happen in the time frames they want to make things happen. You got to plan ahead, make sure these things are going where you want to go. In this situation, understand that if you want to use your retirement account to go buy a piece of property, it's going to take some time to put it together. Figure 2 to 4 weeks. Even if we expedite things with the trust companies, they are buried. We are buried. Everybody's busy right now, and it just takes time to move that money. The toughest thing is not getting the account open. The toughest thing is move the money. The reason I brought up the comment on reverses is we do a fair amount of time for reverse exchange. You've got to have the financial ability to buy today before you've sold something. And so the best course, you know, if you don't have the money, we can't do the exchange. So a lot of times the best course of action is for somebody to use that 60-day rollover. What I mean by that is you're entitled, if you haven't taken any money out of your account, you're entitled to drain that account once a year for up to 60 days. So we might have a situation where you need to reverse exchange. You take your retirement account, pull it out, and we use that money to go buy the property. Now we're racing because you got 60 days to get the money back in your retirement account. If you don't, it's going to be treated as distribution. You're going to pay tax on all of it. But I'm just throwing ideas out. It's a crazy world right now. Things happen fast. And if you're looking different sources or opportunities that are out there, that's one of those opportunities that we've been utilizing. This is a checkbook IRA. This is what, if you're going to buy real estate and manage it, this is what you're going to want. So that last page I talked about just moving money from a custodian to a custodian. Now, we're still going to do that. So a checkbook IRA still is going to require that to happen. If you look at the left side of these bubbles here, you've got IRAs, 401k plan, Roth, all those different things. If you've got traditional funds and Roth funds, it's going to require 2 custodial accounts. But we're going to create those custodial accounts. So the money's going to move from wherever it is today into the new custodial accounts. A checkbook IRA just means we're inserting an IRA-specific limited liability company between the trust company and the ultimate investment. So the investment the trust company makes, or your custodian makes, is the membership interest in a new IRA LLC. The manager of that LLC is you, the investor. So once again, what the investment is the investment that's being made, instead of buying a stock or buying the property directly and having the deeded owner be the trust company is the member of that new IRA LLC. The trust company could be one of multiple members. That IRA LLC could contain your account, your wife's account, could contain your traditional Roth money. It can contain you in there personally along with your retirement accounts. That bubble can contain any number of people or entities. So that investment's done by the trust company. As soon as they make that investment, the trust company is pretty much done. And from that point forward, you're going to have a bank account in the limited liability company's name and federal tax ID number. You as manager have the power of the pen. You're the signer on that account. So you're going to open an account in the bank of your choice. Remember that security point I mentioned earlier. Pick the bank you like. You're going to have the account in the LLC's name and federal tax ID number. You as manager or signer on that account. So now as soon as you've got that account established, how do you buy a piece of property? Well, talk to your broker, go buy it. Just write the offer between the seller and your IRA LLC. Now what happens? For a dozen years, we've been running radio ads. I have people call up all the time, hey, I heard you on this, I heard you on that, and I've been listening for years, and da 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 da. And so they call up and ask, can I do this? Can I do that? My response is yes or no, depending on what they're wanting to do. But if it's yes, then they say, okay. And I tell them it's going to take 2 to 4 weeks to put the account together. And when do you think I hear from them? When do you think that I get the call that they want to put it together? Well, I found the property, I made an offer on it, and now I need my account set up. Technically, that's a prohibited transaction. And you're thinking, well, why is that a prohibited transaction? Because you personally tied up that property. Now you've got to sign that thing over to your retirement account, which is a prohibited transaction. So we don't want you to do that. If anybody on this call scuba dives, you know, the idea is you plan to dive the plan. If you fly, you're going to file a flight plan. If you've got a big boat, you're going to file a float plan. You're going to let people know what you're doing, how you're doing it. You're going to get ready to do it before you go and do it. And this is no different. You have to structure this thing prior to finding that investment, because when you make that investment, it's probably going to need some money, and you cannot personally put that money in. One thing I didn't mention, I really apologize. On the disqualified party slide, siblings are not disqualified parties. So if you find a piece of property that you want to write up, have your sister write the offer, have your brother write the offer, have your aunt write the offer, your uncle. So once again, aunts, uncles, siblings are not disqualified parties. It's the lineal ascendants, descendants, their spouses or any legal entity own a controlling interest. Those are disqualified parties. So once again, get this thing together first, then go hunting. Don't go hunt and then put this together, because it's going to take time and it's going to be frustrating. Imagine if you're a broker and you've got, number one, a basic account to buy a property. You're in a situation where it's going to take time and it's going to require the custodian's approval. So, you know, why a checkbook IRA, income and expense, anything goes in and out of that LLC. The LLC is the owner of the asset. You're the manager of that LLC. You got the power of the pen to buy it. You write the check, and the expense is going to be a check written. All the yield off that investment just goes in and out of that account. Your only interaction with the trust company is annual valuations of all cash and assets the LLC has, because the trust company has no idea what you've purchased, what you've done. So once again, I'm going to stress the only situation. So a basic account, you're dealing with that trust company anytime you do anything. A checkbook IRA means you're only going to provide them annual valuation of all cash and assets in the LLC. You don't have to ask them for anything. So that's the good side. The downside is too much control. You know, if you want to screw up, you're going to screw up. And I've had people screw up. So you've got to be careful with this. You got to understand what's going on when it's going on. Another benefit people don't think about, a lot of trust companies understand when we're looking at a trust company, there's a few different issues we got to look at. You know, one that's important to everybody on the call is probably cost. But you got to understand that cost too, and understand that when we put one of these things together, the costs are obvious. They're right there for you to see. Where a lot of times your Wall Street stuff, it's sort of embedded in different things. You don't really feel that pain as much. But if we've got a trust company that's charging you based upon the value of your assets, it's one thing on Wall Street because you got set values. It is what it is. If we're talking about self-directed accounts, we don't have set values. I mean, what's a property worth? It's always highest best use. There's not a number there that's going to say, yeah, this is what it's worth. So once, number one, you got a valuation situation. You need, if you're a broker, hey, it's the best opportunity for you is to provide that valuation, your CMA each year. They want a professional opinion of value, so you're going to provide a valuation to your client every year, and they need that, and it maintains your relationship. That's the best thing you can do. Your clients need it. You know, the other situation is that you've got to understand, once again, what that thing is worth, but also that it's a piece of something that's in there. And that if you're being charged by the custodian based upon values of assets, you don't want to be working with a trust company that's charging you based upon the value of your account, because now you're adverse to the trust company. They want it to be worth more than you do. And that's not a healthy situation. So I like trust companies that are not charging my clients based upon the value of an account. I want them charged based upon the number of investments they have. And you're still, well, gee, my checkbook IRA LLC has 50 properties. I'm going to get killed at $20 an asset. No, with a checkbook IRA, there's one asset, one thing. So a lot of times, once again, that checkbook IRA really helps you out. The initial cost is more, but the custodial fees gets reduced dramatically over time. So I love the checkbook IRA. It just gives you the power of the pen. It gives you the ability to do what you want, when you want, as you want. And a basic account requires the trust company to be involved with every action you got going on. So what's checkbook IRA cost? Really, we charge $2,300 one-time fee. Understand that most of the time people are paying with their retirement accounts. You're talking pre-tax dollars to pay this thing, and so that helps you out some. After we put it together, you're looking at custodial fees, and the custodial fees are going to range obviously from custodian to custodian. The custodian we use primarily has got a base quarterly fee of $65, $20 additional per asset. Once again, a checkbook IRA, you're looking at one asset, so it's $85 quarterly. And that's not too bad. Now, I was going through when I was working on this presentation late last night. I dug back into some presentations back in the 2000s, and I think the annual custodial fee at the time was like $100 or something like that. So, hey, has there been inflation? Certainly, definitely. So just understand that you've got a custodial fee, you've got a state fee. State of registration varies dramatically. I mean, Oregon is $100 a year. Washington, for example, $60 a year. California, sorry, $800 a year for an LLC. So typically, we're going to put the LLC together either in the investor's state of residency or the state of investment. Some states have foreign investor rules, so we want a domestic entity in those. I believe Texas is that way. So you just got to look at state to state, where you're doing, what you're doing with it, and we'll figure out the state of residency. Obviously, Delaware is where a lot of stuff is. I've got a boat that, and when I bought it, I didn't buy a boat. I bought it was a MIPA, Membership Interest Purchase Agreement, and the boat's I bought a Delaware LLC. So funny how things work. But you're looking at, maybe for a checkbook IRA between the custodial of a few $100, state registration fee. The custodian we use primarily requires a third-party review annually. We charge $175 for that. That could be done by your tax or legal people or we as the organizer. So you're looking at $500 to $700 a year for checkbook IRA. A 401k plan, solo 401k, you're looking at about $300 a year for annual amendments, and that's it, really. So it's very minimal. So the 401k plan, the reasons I like these, I mean, if you're a real estate broker without employees, one thing I want to stress, no employees. I love the solo 401k. Instead of having the checkbook IRA with the custodian, the LLC to maintain, you're just going to have a bank account in the 401k plan's name and tax ID number. You are the trustee to buy and sell things. It works just like that checkbook IRA. Big difference is you commit a prohibited transaction, only the money involved with the indiscretion is treated as distribution. One of the big issues is, as I said, with an IRA, you're going to have tax on leverage with an IRA. So 50% loan to value, you're going to have tax on half the income and half the gain on disposition. 401k plan, you do not have those things. So it's a lot different situation, and they're cheaper to keep going. They're more forgiving. The contribution limits are slightly above what a SEP IRA is, up in the max between all contributions up in the mid $50,000 range. So they're really attractive. If you've got less than $250,000 in a solo 401k, there's no reporting. As soon as you hit $250,000, you've got a 5,500 EZ to fill out. It's a couple-page form. Most of our clients do it themselves, or they have their tax people do it. But very little expense to them. They work great, and it's going to work just like a checkbook IRA, like I said. So prohibited transactions, we talked about these. Borrowing money from your IRA is not okay. 401k plan, one of the other things I didn't hit, you can borrow half what's in the plan to a max of $50,000. So that's another reason I like those instead of the IRAs. But when we're looking at these prohibited transactions, borrowing money from, loaning to, borrowing from, selling to, buying from, we've got that mark right in the middle, unreasonable compensation for management. Understand that with your IRA or 401k, you cannot work on these things. Sweat equity is not okay. That would constitute a prohibited transaction because there's a benefit to a disqualified party. And you're saying, well, gee, why should it matter? The government should be happy because I'm really just increasing the value of my account more. I'm creating more value. Ultimately, at the end of the day, traditional IRA 401k, I'm paying tax, normal income tax on distribution. Well, the government doesn't like that because you're cutting vendors out that they're going to see tax revenue today from. So it makes a big difference in what's going on there. Just understand that you shouldn't work on it. So you can manage the asset. You shouldn't go out, we say, get dirty on it. Don't swing the hammer. Don't paint the building or anything like that. You say, well, how do they catch me? Well, you get audited. They look at your ledger for the account, and there's a check to Sherwin-Williams for $500, and there's no corresponding labor. That's how you get caught. So just don't do it. And honestly, most of the people that come to us, they're more conservative with this stuff too. And even if they're people, I hear people want to flip properties with an IRA. Again, it's a business. If you come to me with a 1031 and you're a flipper, I can't do an exchange for you, and you're paying normal income tax on the sale. Don't do that. Do a modified flip, buy it, fix it, refi it, keep it for a year or two, then do the exchange. The money via the refi is not taxable. In this space, you're sitting in a situation where you just understand you should not work on it. And if you're flipping property with that retirement account, it's not an investment, it's a business. Therefore, you're going to have that unrelated business taxable income in that situation. So, and also I got to stress, what is a flip? I mean, if you buy a property today and somebody comes in unsolicited, makes an offer that's too good to buy, too good to pass up, did you flip the property? Are you a dealer? And I'd say no. I mean, if you bought it and somebody unsolicited comes in, and even if it's a month later or 2 months later, that could be okay. You could do another exchange. And if we're looking at the context of retirement account, you wouldn't have that UBIT in that situation. Now, if you're buying, fixing, and immediately upon completion of the improvements you put on the market, even it takes a year or two, now that's a UBIT issue with retirement accounts, and it's a dealer status issue with money out of your pocket. So if you've got questions on this stuff, typically I look at the Clarkowski case. That's 9 points used to determine dealer status. If it's in the 1031 context, I'm going to look at whether the property qualifies for 1031. If it's in the retirement account context, I'm going to look at that, and I'm going to sort of look at it with respect to UBTI and whether that's going to apply to your transaction. And I'm going to just stress that UBTI, don't make or not make an investment based upon the taxability of that thing. Just factor that tax into the yield on that investment. So I'm going to say that again. Understand that you should not be making those investment decisions based upon that thing alone. It's a factor that actually increases or decreases your yield, your return on investment. So can we get a mortgage? Yes, it's got to be non-recourse debt. So what does that mean? That means that in a default, the only thing that the bank can take is that asset. They can't come after you. The loan's typically not going to be attributable to your credit, your income, or anything else. The property has to be able to float itself. And they're typically going to want to see, let's say, 15% reserves. It's going to be a lower loan to value, 65%, and you're going to it's going to be more expensive, point or two, a couple points more expensive for that money. I don't understand why more banks don't do it. From my perspective, it's more conservative loan because people just don't want to take the chances they do with personal money out of their pocket. It's just my experience. People come in, like I said, every day with the retirement side of the business, and I don't see them with the 1031 side. So they're more concerned about it. And I think all this is reasonable. They also want to have somebody that's got some prior experience with real estate. They don't want to have somebody that's a noob, comes in, spends all their money on acquisition, then has a problem. So how do we buy the property? Easy. You establish the custodial account, whether it's directly or through us. If it's checkbook IRA, you're going to have to engage. We're an IRA facilitation company, so we're going to structure. We provide the investment vehicles. If it's 1031, we provide the conduit out of what you don't want into what you do want. If it's retirement accounts, the same way. If it's an IRA, it's going to require that trust company. We are going to provide the investment vehicle, which is that IRA LLC. So contact us, tell us what you want to do. We're going to talk through the process with you, talk through your situation with you, and we're going to offer you what we believe to be the best course going forward. But the idea is get this thing together before you go hunting for assets, because if you find the asset, it takes time to put these things together. And as I mentioned earlier, it would be a prohibited transaction for you to take the property off the market and then assign that PSA, purchase sale agreement, over to your retirement account. So if you did that, what I'd tell you is get rid of that one, write a new offer in the LLC's name, and or if it's a base account, in the trust company's name, or if it's a 401k plan, in the 401k plan's name. Just do it right from the beginning. Don't monkey around, and you know, the cost of a prohibited transaction is too great. So you're going to create the custodial account. We would do it if you engage us to do it. We're going to create the custodial account. We're going to do the LLC. If you engage us for a 401k plan, we're going to create the 401k plan, the federal tax ID number for it. With respect to our interest in the LLC, we're going to put the LLC together, the articles of operating agreement, federal tax ID number, the operating agreement. Do not go online to LegalZoom and expect that operating agreement to work. It does not work. It will not work. And I'm not picking on LegalZoom. It's just something that's got to be IRA specific. And who knows, maybe they might come up with one. I shouldn't give them an idea. But anyway, it's got to be specifically structured in this way. Don't pay a lawyer to put it together if they don't have experience in this space. I had a client didn't want to pay us the $2,300, thought it was too much. You know, if you look at, if you got the custodial account, you know, we're looking at, you know, $1,800 difference, you know, which is more than maybe you could get a, you know, an LLC online for. But what happened is she didn't come back to us. She engaged her lawyer, and $10,000 later, they had an LLC that didn't work. So just pay people that have experience in this space. Pay people to do what they know what to do, and get it done that way. If financing is required on this thing, the next page we're talking about contingencies in a transaction. If it's a basic account, you've got to have a contingency in there that this purchase is subject to the custodian's approval of the investment. Otherwise, you could lose your earnest money on it. And once again, it can't be money out of your pocket. So the earnest money technically needs to come from the trust company. So a basic account is tough. A checkbook IRA, once again, you're just writing the offer between the seller and the IRA LLC. You as manager have the power to do all of that stuff. So in a basic custodial account, you need to have a contingency stating it's subject to the custodian's approval. If financing's in there, I know purchase sale agreements nationwide contain verbiage talking about financing, but you need to specifically state IRA specific financing. I don't want you to rely upon the boilerplate and now you lose the money, your earnest money, because you didn't state specifically that it was an IRA specific loan. Also, again, if you're putting things together, ask for time. Don't get yourself in a situation where you're behind the 8 ball, because it's going to take time to put it together. Get it together, then go to do it. Now, as I said, you want to have enough money to make the acquisition, cover any potential carrying costs. So whatever this thing owns, it's not yours. The insurance on the property is not an additional asset on your homeowner's policy. It's new policy in the LLC's name and EIN. If it's a 401k plan, new policy in the plan's name and EIN. It's not yours. It's Susie's down the street. Always remember that. So get enough money in there to make the purchase, cover any potential dark times. If it's a piece of dirt, you know, you've got taxes and insurance annually. You got to have enough in the account, or have the ability to get enough in the account to cover the carrying costs during the expected hold. If it's a cash flowing property, then it would require less, because you got money coming in to work with this stuff. All right. So enough to buy it, and you know, you hold it through that investment period. What am I going to make? How am I going to make it? When am I going to make it? Now you've exhausted this investment, and it's time to get rid of it. You're just going to list it with your broker as you normally would. The listing agreements between the broker and your checkbook IRA LLC, or the broker and your 401k plan, and it's sold. And when the property sells, the funds just go back into the account, totally tax deferred. Now, I'm sitting here, you know, talking to you as a guy that does 1031s with this hat, IRAs with this hat. And, you know, tonight's presentation by Mr. Biden is going to be interesting with respect to my 1031 hat. I'm not expecting much of an impact from my IRA hat, but you know, if we're talking about what we're talking about today, this might be the way. If they really put the crunch on capital gains and impact 1031 somehow, you know, real estate, this might be the way you're looking to diversify your portfolio going forward. This is what it is. So hopefully that's not the case. No matter what, you know, as I said, 1031 is 100 years old. This stuff's back to the mid 70s. Few examples and we're done. And like I said, I'm scrambling through this. If you have to sign off at an hour time, I totally understand. There's 6 examples and then just a summary at the end. But in this situation, one of our early clients came to us and he just wanted to diversify his account outside of his Wall Street offerings. And you know, one of those bullet points was you can make an impact locally, right? So he had a buddy that had a development at the coast having problems. He wanted to help his buddy out, saw that as an opportunity to help his buddy. Plus, he didn't mind having some land down by the beach. So he went and initially self-directed a small amount of money, made that investment, which helped his buddy out, gave him some further diversification. And a lot of times people do this. They sort of dip their toe in the water. So as that thing worked along, he was happy with that. And ultimately he started asking what our other investors were going to do. So what ultimately happened, he ended up shifting more money in the account and going into multifamily project. All that worked out great for him, and he's just increased his interest in the self-directed space more over time. But it's just diversification, tangible assets, inflationary hedges, and in the times that we're in, I think it's really going to be more and more important all the time to get some tangible stuff to make sure you're not going backwards with your investments. This is the last crash. Once again, this is a situation where you got to look at opportunities. This is guy invests in what you know. So a gentleman in Bend, Bend, Oregon, sort of boom or bust. A lot of those places are like that. So right now it's absolutely going crazy. But if we look at the situation where what this gentleman did, he was a developer. So he literally got dirt cheap, and he went out and so we put a self-directed IRA together, checkbook IRA, to land bank those properties. So the issue is, he buys the property and ultimately he'd like to develop it. Well, he can't develop personally using his company, develop the lot that's owned by his retirement account, and he couldn't have that company buy from the retirement account either. So we created a second limited liability company for the going vertical, the construction portion, and that second limited liability company, we reduced his ownership to 1/6 interest. Therefore, it was no longer a disqualified party to his retirement account. And so as he needed to build stuff out, they would buy the property, and transfer buy the property from the land bank entity, the development entity, build it all out, and the land bank entity just kept picking up property. So that was a situation where if you look at it on the face, it was problematic, but we found a way to get around it. Opportunity 3, a situation where people came to us. This gentleman, I love this guy. He had institutional medical practices. And what he did is he came to us, and first question was, hey, can I take my money, go out, buy a mobile home RV park? And the answer is, well, yeah, you can do that. And so we started talking about that. The next day he calls up and he says, well, hey, can I buy notes? I said, yes, you can certainly do that, Leroy. And so he ended up shifting gears. The guy had lots of real estate, tired of the terrible T's, toilets, trash, tenants, turnover. So what he wanted to do is buy notes. And so we created checkbook IRA for him. The first note he bought, and keep in mind, this is the last crash, it was a condo in Palm Desert, $70,000 purchase. It had been a couple $100,000 previously. And the buyer just wanted, as a loan, a first at 50% loan to value, paying 11%. This gentleman started off making that investment with, maybe moved $100,000 in the account initially. During the ensuing years, he moved several $1 million into his checkbook IRA, and he bought paper with all those notes. And I think the best note he had was like a $10 million property, $1 million note paying him 19%. It was a wind power property, and he was thrilled at that one. He just thought, you know what, I hope they default in that situation. But once again, we've got lots of people that buy notes, and I think they're a great opportunity. Next example, this situation where we had a young couple wanted to buy the property adjacent to, they lived in a subdivision, and the property, the piece of dirt next to their house came on the market. They didn't want to have somebody go buy it and build something they were just going to have to look at. They liked having that privacy. So they asked, well, could we go out and buy this property with our IRA accounts? And, our answer was, well, yes. And so in that situation, we created the IRA LLC with money from each of their retirement accounts. So we had his account, her account, and ended up combining that money, buying the property. Now, I want to leave you with a caveat: you cannot use that property, so don't put a fence around it and include it into your yard. Technically, you shouldn't be using it. One of the court cases in our space on the retirement side was, actually it wasn't a court case, it was just a failure, but a company, a gentleman had a self-directed IRA, bought the property adjacent to his business. He was parking business trucks on it, got audited, and ended up blowing up the account because of that was a prohibited transaction because of his usage of that property owned by the retirement account by his business. So don't do these things. Ask the questions early on. Take care of things. And this bubble, once again, we combine his or her accounts and personal money also to make that transaction happen. This is a situation that we haven't had to deal with yet, but I've just put this slide in because I think it sort of offers you a glimpse of what's possible out here. So the last crash, we had people, obviously losing properties. And this is a situation where a gentleman came in and a developer had a $3 million piece of property, $1.2 million lien on it. The lien was with a bank that was failing. If the bank goes away, the loan goes away. He didn't want to lose $1.8 million in equity. He ultimately wanted to build it out. So he asked if his father's, if we could take his father's IRA to pay the property off. And if you look at it, no, that you can't do that because you'd be taking that money and there'd be benefit to Junior. So what we did do, though, is we created a new limited liability company, and we did a checkbook IRA for Dad. Now, Junior contributed that property to the limited liability company. Simultaneously, Dad's checkbook IRA wrote a check into that limited liability company. Now, who owns that property? The property is owned by the new LLC that has the IRA and Junior as its members. So it was then able to pay that property off and save the property, and ultimately this gentleman went vertical in the future, getting people where they wanted to go. The last example is actually a rollover business startup. So once again, it's mobile home RV park. And by the way, these are all transactions that are real that we have done and did them a long time ago. Some of them more recently, but this is all stuff that's been done and seasoned. So this couple came to us, retired. They need more income, so they asked whether they could go out and take their retirement accounts to go buy this mobile home RV park, which, as I've previously said, they're not going to personally benefit from until they take money out as a distribution. So the cash flow on the property, it's not theirs, it's the retirement accounts. They will get that benefit when they take a distribution. So they asked, can we buy the mobile home RV park? I said, yeah, sure, fine. We'll do a checkbook IRA, both of you are as members, and it'll own the asset, and there you go. Well, then they mentioned they wanted to manage the property and live there. They want to be on-site managers. So cannot do that with an IRA for a variety of reasons. But what we did do is we created that rollover business startup. We moved both their IRAs into a 401k plan, created a C Corp. The plan bought the Corp bought the property. And guess what? They got an investment, they got a job, and they got a place to live. And I just love that. And if you've been to my classes before, I always throw this slide in there just because I just think it's a great example of what's possible in this space. So once again, never say never. Ask the questions. The only dumb question is the one that's not asked. So plan ahead takes 2 to 4 weeks to establish your IRA. Purchase all types of property with an IRA, SEP IRA, Roth, 401k plan, it doesn't really matter. You can purchase with family members and friends. You just can't purchase from or for them. You can't sell to them either. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage, negotiate from deals, inception, the IRA LLC's name, or the 401k plan. Once again, we don't want to see assignments. If you've done that, get rid of the thing. If you personally tied it up, get rid of it, then rewrite it in the checkbook IRA name or the IRA name or the LLC's name. Don't overextend. Plan on keeping a nice cushion for reserves. Real estate is not an alternative investment. It's a real investment. It's real, and it's the ultimate investment. It's the ultimate tangible asset. We've got obviously IRAadvantage.net or .com. You can get to us through there. You can get to us for the 1031s through 1031exchange.com. We've also got a property listing site. If you've got assets, you're looking for something, or if you're a broker and you got something you want to get in front of our people, post it on post1031.com. That's where we send our people. Please take a look at our social media sites. If you've got interest in things, you want to find out certain aspects of investment real estate, for example, you go to 1031 Exchange, or just go to YouTube and type in 1031 Exchange and Equity Advantage, and you're going to get to our YouTube channel. And there's going to be information on there on everything from life contracts to structured sales. You're going to see information on cost seg studies. All kinds of different things are in there. Tenancy in common stuff, TICs, DST, Delaware Statutory Trust, all kinds of stuff. The IRA Advantage YouTube channel is going to do the same thing in the IRA space. If you are looking for information on something, please let us know. If it's not up there and it's something we see a value in, we're going to put something together. We're going to help you out. We're going to help your investors out if you're a broker. Reach out to us, ask the questions, and if you've got something you need, you're going to get some information from Celia at iraadvantage.net, and she's going to be sending out, if you want CE, she's going to be sending that out. But if you've got a need or you've got a question on anything we presented today, please reach out to her. She'll get those questions to me, and we'll get those questions answered. Thank you very much for attending today. Best of health to everybody, and I look forward to speaking with you soon. Thank you. David Moore, IRA Advantage, iraadvantage.com, signing off. Thank you. Take care.